So good afternoon. I'm McLaughlin. I'm with Cohen and Company. After the last panel, I'm a little bit uncomfortable saying this, but I am an auditor. Sorry. So I hope I won't disappoint you, certainly, and we hope to solve all the problems that the industry faces, as was suggested in the last panel, right, David? And so we're excited to be here. It's interesting. This is the fourth go-round of this panel, and the title has not changed, but I think the issues have changed dramatically. At Cohen and Company, we've been fortunate enough to work on probably well over 100 digital asset-based funds at this point. And it's been really, really personally exciting and thrilling for me to be part of the proliferation of this asset class. And one of the best parts about it is that there's something new every single day. And that also creates some challenges. And so we put this panel together to help a lot of our clients, people that are thinking about getting into the space, other best service providers in the space, to make sure that we're all dealing with the issues in a good way and being good actors and good stewards of the space. So we have great representation here. We have two premier accounting firms, as well as the premier third-party administrator firm in the space. So with that, I'm going to allow each of the panelists to introduce themselves. I'll start with you, Seth.
Hi, I'm Seth Altman with MG Stover, Director of Technology and Innovation. So as Corey mentioned, we are a third-party administrator, so we are in the details on a day-to-day basis and really interacting with the operations of the fund, the investors, and also helping to manage the treasury of the fund. My role is to really help to innovate through the use of technology and make our processes better. Previously, I was the director of the hedge fund team, so my experiences has been primarily in the alternative space.
I'm Cynthia Peterson. I work with Cohen and Company with Corey out of the Baltimore office. I'm a director and a tax attorney. My background is an estate planner, so I do succession planning for our ultra high net worths. I also work with the hedge funds, and I got involved in the cryptocurrency space at the same time as obviously our firm about, I feel like it was like 4 years ago. It was so long ago. And it's just been very exciting doing a lot of consulting, working with the funds, trying to figure out all the tax issues with limited guidance.
Nice to see each of you. I'm David Byrd with Ernst & Young. A lot of familiar faces at this event. It's nice, especially up here. I'm our firm's global blockchain strategy leader for assurance, which is inclusive of audit, forensics, and a few other areas. We have and do audit a number of exchanges, cryptocurrency exchanges around the world, as well as funds and other types of entities. I did sort of cut my teeth at Ernst & Young, auditing private equity firms, VCs, hedge funds, and traditionally. So it's definitely a familiar crowd.
Yeah, so we're excited to dive into the panel. I think that all of us have been involved in this nascent space for a long time now, and all of us have collaborated probably more than they wanted to, particularly with me involved, right, guys? But we've learned so much together, and so our goal of this panel today is to share all of that with you, and it starts with great collaboration. And what that means and looks like is between the client, the third-party administrator, the auditor, the tax provider, if there's great communication and collaboration, it avoids a lot of issues later. And one thing that we've talked about pretty consistently today throughout all of these panels is that there is a lot of change, and there's a lot of new things happening. So we often see new exchanges. We hear about staking of tokens that creates bonus tokens at a later date. That's something that you didn't see as much 4 years ago. So how do you handle that from an accounting, from a tax perspective? New marketplaces arising, new ways to custody your assets. So you see all these things. And so we wanted to share that with you. But I think to get us kicked off, I think it's important for clients to understand that there is a go-to resource that helps coordinate and collaborate with us as the auditor, the tax provider, the third-party administrator, and Seth, I think you might have some perspectives on that, so I'll turn it over to you.
Thanks. As a third-party administrator, like I said, we're dealing with the fund on a day-to-day basis, and I think even for all of us up here to be successful, we need that go-to person. And we understand that as an emerging manager, you're most likely not going to have the resources to hire a CFO, director of investor relations, a general counsel, and then a whole accounting team. So we understand that, but in that regard, there still needs to be someone within the firm that has knowledge of all these aspects. That can help us with any questions that may arise. So if we need investor documentation and that investor's not responding, we need to go to someone within the firm that can help us handle that issue. If there's a new exchange that gets onboarded, we need someone to help us walk through potentially the documentation on that exchange and kind of how things are treated. And similarly with a blockchain, a new blockchain that you're trading on, if there's staking, if there's any sort of income related to that, how we should be treating it. And so, it's important to also involve, obviously your other service providers when needed. We're not going to always have all the answers, but we do involve obviously the audit, tax, and compliance when needed. Now also you can outsource a lot of these functions. There are those outsourced CFO type of companies out there that can help with a lot of these functions.
So what about record keeping? Critically important. Seems like a silly thing to say, but in this space, I think all of us have encountered some interesting phenomenon as it relates to record keeping. I know at our firm, we've had certain clients trading on exchanges that purge records after a month, which makes it very, very difficult to independently verify certain transactions, certainly makes it difficult to do some of the tax reporting that's required, and can make Seth's life difficult as well. So do you want to talk a little bit about the importance of that?
Yeah, so pretty much what we do on a day-to-day basis can be quite complicated. And I'm not going to go into exactly how we make the sausage, but it's quite complicated. And really what we need is reliable and consistent data. And sometimes the exchanges or a blockchain or whatever other counterparty you're dealing with may not expose all the data. So it's kind of like just getting your bank statement and there's just a bunch of numbers on it, and you kind of have to piece it all together to do a full reconciliation. It might make things quite complicated. Now, having said that, if you're going onto the exchange on a daily basis or however often you need to do it and downloading that data, it makes those conversations a lot easier, because sometimes once the data's gone, it's really hard to go back and retrieve it. And most exchanges don't have that ability, or block explorers for that matter too, don't have the ability to really go back in time to say, what was my balance on October 31st, 2018, right? It's just that doesn't really exist. So it's really important that we do have somebody grabbing all those records, because there's sometimes where even a script that we're running, might not pick up everything, but that was only available for just say 48 hours. So it makes our lives very difficult if we don't have all that data.
And coupled with that, making sure that you keep track of all your wallet addresses. David, Cynthia, Seth, myself are going to ask for that as we go through the process. So this space, unlike most spaces, we have a keen interest in particularly transfers of assets and where everything's flowing to. So it's really, really helpful if you keep track of that along the way, as opposed to trying to recreate it later. David, so today there's been a lot of talk of custody. And I would say, as we sat in the first CoinAlts in San Francisco, which was September 16, I think, we talked a lot about cold storage. We heard Anchorage talk this morning about their lack of confidence in cold storage due to human error. And I think we've seen a substantial evolution in terms of custody of assets, digital assets in this space from where we were at in August of 16. So do you want to talk a little bit about what you've seen and the institutionalization of custody and sort of all those aspects?
Yeah, absolutely. And from your perspective, feel free to chime in as well. It has been wonderful to see the evolution, like you were saying, of this space from so long ago when all the funds and other related entities for the first time had to self-custody their own assets, right? And so then from the audit perspective, we had to come in there and figure out how to audit this stuff directly, how to verify that they existed, and the rights and control, that had to happen. Because there just weren't any custodians. And again, not to beat the custody thing like a dead horse if you're getting tired of that topic, but it's been great to finally see real institutional grade custody offerings. You've sponsoring events like this, it's terrific. But we also need to sort of remember that even though those products are out there, there's a lot of the sausage making in the background that needs to make sure. Just because you move your assets from your own self-custody to a custodian doesn't just, now we're all done, right? Because whereas the auditors were getting comfortable getting evidence about your assets directly, now, well, we've got to get it from them. That is the custodian. And in the traditional space, right, what can the auditor do? You get your client to agree, to send a confirmation, you confirm. There are even some platforms out there today that have a formal policy that they do not provide audit confirmations. We'll see how that works out in the long run as far as their business process goes. But Seth?
Well, what I was going to say is I think some of that is also due to the fact that they don't have historical balances.
Right.
Everything is transactional based to compute their balances, so that's, I think, hard
to confirm something that you don't have evidence of, right?
Yeah.
But that's just sort of, minimum. That's just sort of standard. The sort of procedures that an auditor would need to perform for a self-custody environment are at this point in time the same procedures that we're going to need to perform at a custodian. So we need to work with you and the custodian to understand what that environment is. Now I'll stop in it because I know we only have so much time. But to my knowledge, let me know. I'm not aware of any custodian out there that has a completed SOC 1 Type 2 from, say, from a Big Four. Now, there's some out there, right? So, and I know that's code among certain crowds. So what is that? That is a report around the internal controls of those assets that are just bespoke for the auditor of the fund, right? It's designed for that. And now, look, custodians are racing toward that. Many of them have a variety of other sort of SOC reports, and they're getting there. That would help tremendously, but and even when we get that, you're gonna have to look and see what's the scope of that. What did it include? Did everything check out? So anyway, there's a number of things we have to do, but right now I would say, just let me know, the auditors are, given this transition of custody from self to the custodians, now having those relationships with the custodians to understand, okay, where is it? Is it segregated? Can I test it? What do I need to know, right?
Yep, well said, well said. So another area where we've seen the need for a lot of planning is where we have a blend of what I'd refer to as a liquid hedge fund type product. So you hold Bitcoin, Ethereum, the more liquid digital assets, and you have VC type investing where you have ICOs and SAFs, and that requires a tremendous amount of coordination and collaboration. So Seth, you want to quickly touch on a few of the issues that we see when we face those types of blends of liquid and illiquid products?
Yeah, so over the last few years, really, there's been a shift in the type of funds we've been seeing. So originally, it was that a trading strategy with illiquid securities or coins in there. And so what a lot of funds were doing was side pocketing those. And what a side pocket is, it's just really removing that asset from the general pool. So that the people that were in at that time are only getting allocated the P&L there. So that's an important consideration there. Valuation obviously on these is pretty paramount. Now, we've seen a shift now more to the illiquid side, being held in a private equity or closed-end structure. And then also those have sometimes a trading strategy or liquid trading strategy to go around with it. And so that can create issues on the waterfall, calculating, the distributions out to partners. When does that liquid trading strategy actually liquidate?
Right.
And should be distributed.
So one other area too that's been an interesting and different experience is valuation in this space. So there's nuances both from a liquid portfolio perspective as well as from an illiquid perspective. And so let's start with the hard one first. I mean, they're both hard, but the more difficult one is the illiquid portfolio. So the number one thing I would say is it's really, really important to get on top of this straight out of the gate. And there sometimes is a misperception that it's okay to hold ICOs and SAFs at cost. And to some degree that may be true for a period of time. However, even during that period of time, it's something you can't do blindly. And certainly as you get 6 to 9 months down the road, cost somewhat comes into question at that point. And so what is the fair value? GAAP requires fair value, and you're going to be required to strike fair value. One interesting thing I wanted to say is that the AICPA, which is the American Institute of Certified Public Accountants, in August, actually issued guidance as it relates to valuing illiquid investments in investment companies. And as part of that guidance, one thing that they are recommending pretty strongly in that is that at the point you enter into an illiquid investment, you enter into an ICO or a SAFT or whatever it may be, that you actually construct the model that you plan on using to value that asset at fair value in the future and calibrate your assumptions, your unobservable inputs or your assumptions that go into that model to have it match up to what your cost was, so that therefore when you get further down the road and you're valuing your investments in the future, you're not seeing a lot of volatility as it relates to the value of that investment, merely because you're going from just using cost, because that's what you entered into at an arm's length, and now you're implementing a model with different assumptions, and you're getting fluctuation in valuation based on just implementing the model. So that provides more consistency in financial reporting. Valuation of these assets is tough. There's not a lot of comparable companies like you see in traditional VC type investing. And so it's really, really important that you coordinate with your admin firm, your auditors, straight away. And some high level best practices is we have to stay on top of the project and what's happening with the project, what the state is, what the status is, how it's progressing. Are there second rounds of financing that have gone on that indicate some kind of fluctuation in the value versus the time that when you got into the investment? Are there futures markets that are trading? Are there OTC markets that are trading these types of assets? What are the restrictions? How long are the assets restricted in terms of being able to trade it, and how does that play into a potential discount, and what is an appropriate discount rate? And it's critically important to coordinate with everyone on this, certainly early. I would say this past audit cycle for us at Cohen, this was probably our most labor-intensive part of the audit process. And us and our clients, I think, are very, very much committed to being on top of that earlier, this next coming cycle to get ahead of it. The auditors are going to want to assess the reasonableness. They're going to expect clients to have support for how they struck their fair values. So, and just having a one-liner that says fair value is cost probably isn't going to be enough unless you entered into that like a couple days before year end or something like that. Also, for liquid digital assets, it's important to have a policy of how you're going to strike your fair value. GAAP generally says it needs to be marked at the principal market. In the digital asset space, that's really, really hard because there's a lot of different markets. Principal market, by the way, is defined as the market with the greatest volume of activity. Real easy when you're trading like a IBM or something, not so easy when you're trading a digital asset that trades in many different places, and plus the OTC market. So what I'd say is have a policy, but triangulate that policy to as many sources as you can. Our firm pulls pricing information on liquid digital assets from 9 different exchanges, as well as 3 different data aggregators. And in addition, we're pulling information to kind of try to perform diligence on those data aggregators periodically, and we compare all of those to our client's strike for reasonableness. So, Cynthia, I believe there's some things from a valuation perspective that impact tax as well that you'd like to talk about? So
yeah, sure. So it's a little bit different from what Corey and the other panelists are talking about with valuations as far as from a GAAP perspective within the fund. When you're talking about valuation from an income tax perspective, we're really more talking about the token issuers. If you are issuing tokens to your employees as payment and it doesn't have a readily ascertainable market, then you really do have to determine what's the value of that token that you're issuing for reporting purposes for their W-2s or other vendors on their 1099s. Additionally, on the past panel, there was discussions about, charitable contributions. There's valuation issues around that as well. So, again, if you have a token and at cost, it's not necessarily going to be exactly what you're going to have a charitable deduction based off of. So having a proper valuation on these assets from an income tax perspective, which again is separate from what the funds are doing as far as their NAV, is definitely going to be important.
So one last thing I wanted to make everyone aware of, and then we're going to have some fun with Cynthia putting her on the spot. So, audits of digital asset entities is much different than what I refer to as traditional hedge funds and things of that nature. So there's a lot more communication and collaboration that needs to go on between clients and the auditors as well as the admin shop. And so, I just want to make sure that everyone understands, David touched on this earlier, in order to verify ownership and to verify existence, in a traditional hedge fund, you send Goldman Sachs or JP Morgan or Morgan Stanley, whoever, a confirm, and they send it back to you, and hey, everything's great. In this asset class, you have cold storage, you have different exchanges, you have different custodians, you have wallets open and closed during the year, and so in this space, there's an opportunity to send assets to the wrong place and things like that. You don't have legally titled accounts with the fund's name on it, so we as auditors are very interested in where everything goes. So we perform wallet roll forwards over everything, so it's very important for us to understand all the different places those assets touch, so we'll need clients' help with that. And in addition, verification of ownership and existence, so we will perform roll forwards of wallets via blockchain explorers and things of that nature, but to verify existence often requires your input because we've got to make sure that the client has access to the private key that gives them ownership, right? And so that requires us to collaborate in a different way. It's not as easy as just getting a confirm back and signing it off. So here we go. So now we're gonna have a little bit of fun with you, Cynthia. There was a lot of pressure put on you in earlier panels. I think people were saying things such as there won't be any tax charged on staking in the future, so we'll see how you feel about that in a minute. But before we get into that, I know there was talk of new tax guidance coming out, which got everyone really, really excited from the IRS.
I mean, I was excited.
And I think, wasn't it supposed to come out in like a month or something like that? And this was like in the spring, and where are we?
We're nowhere. So, so yeah, the IRS commissioner essentially came out and made some statements that there would be guidance expected soon. The statements were made on May 30th, and he essentially alluded that, in the next 30 days, we're going to be, getting some guidance. And then, I don't know if everyone's aware, but 21 representatives in Congress had sent a letter to the IRS essentially saying, hey, we need guidance, what's going on? And the IRS commissioner again responded in a letter and essentially said, look, we have guidance. It's coming out very soon. It's going to be a RevProc, a revenue ruling. We're going to talk about cost basis, allocations, whether you use FIFO, LIFO, or specific ID. We're also going to talk about the taxation of hard forks, and silence. So we haven't gotten any guidance in addition to our guidance that everybody's aware of, the NOS 2014-21, which gives us kind of our basis groundwork of how we've been handling and treating crypto from a tax perspective, again, since 2014. Instead of guidance, we did get education letters and enforcement letters, so I'm just going to jump right into that.
Perfect.
So in the end of July and throughout August, the IRS issued about 10,000 what they called education letters. There were 3 different versions of the letter. One was 6173, 6174, and 6174-A. Essentially, all these letters just kind of made a statement. Hey, we're aware that you have cryptocurrency or may have had cryptocurrency in the past, and by in the past, I mean between 2013 and 2017, and you might have reported it, but we're not sure if you really reported it correctly, so this is how we really want to see it. These are the schedules, these are the forms, this is where you should send your information. Why don't you go take a look back at your returns and let us know, did you do it right? It's really a fishing expedition. At least that's for two of the letters. So the 6174 and 6174-A were just saying, you reported something, we don't trust you. Go back and look at your forms and see if you did this right. The 6173 was we know you have this and you haven't reported anything. You have 30 days to respond. So it was really more of an angry, in my opinion, letter. And so I'm really sorry if you got one, but if you did, hopefully you reached out to counsel or to your auditors, or not auditors, or accountants, to make sure that you responded properly, because you did have to respond in writing, and they're asking for substantiation as to why you have not reported. And the issue here is that this response could potentially be used in criminal enforcement in the future, so you really have to be careful about how you respond to these letters. Again, the 6174, 6174-A did not require a response. It was just a fishing expedition to see, we know you reported, we just want to make sure you did this properly. We're giving you some education on how the reporting should look. 6173 was really more of a threat, which goes back to substantiation and keeping good records, because as Seth was saying, not all of these exchanges actually will have the information that you need, 1 month, 2 months, 6 months, a year down the road. And if you can't substantiate when the IRS comes asking you questions, they're essentially going to, take the harshest route against you. So that happened, that was through July and August. Also in August, we saw enforcement letters. These were notice, CP2000 notices. The CP2000s have been around. They're not specific to cryptocurrency. Essentially what it says is that there's a matching problem. So the IRS has obtained information from some third-party source that doesn't match the information that you reported on your return. Now in the cryptocurrency space, the main third-party information that they're probably going to receive is going to be a 1099-K, which is issued by some exchanges depending on the number of trades or the volume of trades that you have on that exchange. The problem with the 1099-K is it reports the gross transactions throughout the year without taking into consideration whether the transaction itself might have been non-taxable, as if you had pulled something off the exchange into a personal wallet or moved it to another exchange, but you haven't actually transferred it to anyone. And it also doesn't take into consideration the taxpayer's basis. So the amount reported on 1099-K is not going to be correct. And the IRS is aware that it's not going to match perfectly, but they just are kind of sending out these feeler CP2000 saying, hey, someone else told us that this was the amount of trades or this is the amount of income that you should have reported. You reported this amount. All they want is substantiation. That notice should be taken very seriously, because you really only have 30 days to respond based on the date on that letter. If you don't respond within those 30 days, that tax increase will then become a deficiency notice, which you can only dispute in tax court. So you have to be careful when you get a CP2000 notice, similar to if you got a 6173 education letter. But that's about all we've got right now. We're still waiting on formal guidance. Again, we do believe, because that letter to Congress, that it should be a revenue ruling, should be a rev proc. We're hoping it'll be on hard forks and cost basis allocation. I don't think it's going to expand much outside of that, because I just can't imagine that the IRS is really up to speed on what they want to do yet, especially, again, talking about the regulators really aren't there either. So it's going to be very limited, but hopefully it will come out before the end of the year. We'll see.
What about FBAR? So I think there's been some important updates related to FBAR reporting. Maybe you could share.
Yeah, absolutely. So FBAR reporting, just so everybody's aware, is essentially a report any U.S. person, including entities or individuals, has to report if they have 10,000 or more at any point during the year in the aggregate of assets in a foreign account. It's unclear, it's a little gray on whether cryptocurrency, foreign exchanges, and or decentralized exchanges, or potentially a hot wallet where you're not sure where it would be located, could be considered a foreign financial account. Now, FinCEN, which is the Financial Crimes Enforcement Unit, they are the one that receive the FBARs. The FBARs are due generally April 15th. There's an automatic 6-month extension to October 15th, so if you haven't filed when you have time. They issued a statement in 2014 that for the 2013 reporting year, they didn't think cryptocurrency should be reported. Virtual currency on a foreign exchange is not generally the type that would be reportable pursuant to the regulations. And then there was silence. So the conservative route was, okay, there's substantial penalties if you have failure to file these forms. So we generally recommend for our clients to file the FBARs. The ICPA had a follow-up question to FinCEN and said, hey, do you still think these are reportable? Is there any information on that? And essentially a statement was made that, again, no, virtual currencies held on a foreign exchange are not the type of assets that are considered financial accounts for this reporting pursuant to the regulations. This could change at some point in the future. The IRS may, have a different opinion and issue some guidance, maybe potentially with the guidance that we're expecting. I doubt it, but maybe. So It's still, in my mind, a gray area, because this was just a statement. It's not formal, it was not put in writing, it was not issued in any way that you can generally rely on, other than the fact that it was a statement that was made to the AICPA. So if you want to talk to your clients about it, they may still want to take the conservative route and still report on an FBAR. Again, it's just an information reporting. There are some challenges with the FBAR, because the way that it's set up, it's really more for bank accounts, which obviously, as you're aware, the foreign exchanges, any cryptocurrency exchange, you don't really have like an account number. Sometimes you don't know where they're located, to have an address or what country they're located in. So it can be kind of difficult to file these forms. So it's really up to the client. So you really should be thinking about that. What route do you want to take? Do you want to, follow with the statement saying, hey, look, this isn't reportable pursuant to the regulations, or do you want to take the conservative route of reporting? It's really a question and a discussion that you should be having internally. But so we'll see what happens, but I think for the most part, we're still generally taking the conservative position that you should report. But there's an argument not to.
So since you're on a roll, we'll get to the real hot topic, which is staking. It's become more and more prevalent. We heard some concerns earlier panels about recognizing the tokens received via staking as ordinary income straight away, and maybe those tokens go to zero at some point. What are the tax considerations? Where are we at with that? Any thoughts you have on staking in general?
Right. So again, the only guidance we have right now is Notice 2014-21, which specifically talks about mining income. So that's going to be more proof of work consensus. So it doesn't really fit it doesn't really fit staking. So the argument is staking considered a realization event similar to mining? Is it considered a non-realization event, which actually David and I were just having this conversation. Can we get there? And also, is it going to be considered trade or business income? What level does it have to rise to become trade or business income, similar to mining? Or is it more passive income? Where is your staking tokens, where are they considered sourced? Is it where your servers are located? Is it where the manager or the individual who's pressing the button to, monitor the wallet, is that where your source is going to be? Do you have issues with, should you outsource this because you don't want it to be U.S. source? You have to think about, who's going to be receiving those rewards. If it's going to be considered ECI or effectively connected income to a U.S. trade or business, are you going to have withholding issues if you have foreign, LPs? Also, if it's considered passive, so let's say you're not running a masternode, you're not really validating transactions, you're just holding it as a wallet. Is that just more passive income? And that way it'd be FDAP, so there are still withholding issues if you have foreign partners there. If you go more towards the trader business, you are running a masternode, your activities are substantial enough that you believe you rise to the level of trader business. Now you have ECI because you're in the US. Is it better to just outsource that staking activity to prevent the ECI from affecting your foreign investors, and also UBTI, which affects your tax exempt investors? So there's a lot of questions around staking right now. Generally, it should be a realization event. You're going to have income. The question is, what type of income are you going to have? Are you going to have trade or business income? Or are you going to have passive income? Again, there is an argument that some people, I think, are trying to utilize where it's a non-realization event if pursuant to your initial contract when you purchased the coins, that you took into consideration all future stake coins that you could possibly receive and included that as part of your purchase price. Then when you receive those coins as you're staking, then it's not really a realization event because you've already purchased them. I haven't seen that work. I don't know if the IRS would be okay with that or not, but it definitely is something that people are talking about. It's people on the other panels talking about it won't be income in the future. I'm sorry, I can't get there, but maybe when the more guidance comes out, maybe you can get to that in realization event if your contract specifically lists out for the first 500 tokens, I'm including this in my purchase price. Maybe you can get there, but as of right now, I haven't seen anything drafted that well for that specifically.
I wonder why. It's not complicated at all.
And it's very simple from an accounting and operational perspective as well. So, David.
Yeah, but I'm sorry. Just if you do have trade or business income, that's really bad for a fund.
Right.
Right.
Yes,
so how would funds get around that issue?
Well, again, so that would be where you talk about side pocketing. We generally don't want to see the staking activities unless it's very, very passive occurring in the fund. We'll see a related entity being created where the tokens are, I think there was a discussion on this on one of the earlier panels, where you lend the tokens to the related party and the related party does the staking, and then it's a sort of a fee arrangement back and forth. Also, again, outsourcing out, so make sure that it's offshore. If it's offshore, then it wouldn't necessarily be considered ECI because it's not US source. So there are ways around this. There's a lot of strategies strategy and planning that you can do, but generally, yes, we don't really want to see this in a fund.
So talk to your tax provider prior to launching on that, for sure.
And also, if you have an ECI issue, you could be looking at state source income as well, which creates additional filings and burdens on your LPs.
Right. Well, since the accounting and operational side is so easy. Yeah. No, I mean, or audit for that matter, right? You know, Diogo made some comments early this morning about how, look, these protocols, these blockchains are quite different from each other, depending, right? And especially when it comes to the staking one. So we get it, you know, you're sitting on a bunch of this coin, right? And so unless you want to be diluted because everyone else is staking, right? You want to be doing this, or you want your custodian to be doing this on your behalf, right? Or you want to engage a related third party to do it on your behalf, right? There's all these, certainly the incentive. My team at EY stakes just about everything we can. We stake directly. We stake by delegating to a staker or baker, if you're talking about Tezos, right? And so they're just, from an audit point of view, you've got to assess sort of what are the risks, you know, what sort of evidence can we get to verify that, yeah, okay, this came from staking, right? And so a lot of these things are obviously public blockchains, and so it's visible in various ways, but Tezos and baking is very different, and delegating to that is very different from Cosmos, right? And what are the risks? Well, slashing, right? That's the sort of term of art in the space. It's not that typically the entire amount of your coin that is staked, which by the way doesn't have to leave your own wallet, even cold storage wallet, is at risk, right? What it is the sort of staking rewards are at risk in varying degrees. I think Cosmos has like maybe up to 5% of your stake coin could be at risk. So anyway, you have to evaluate this stuff. So that's just from kind of the audit, from our audit perspective. And then accounting treatment. How are you recognizing? Is this revenue? Is this revenue per 606? I mean, it's very unlikely that funds are probably staking directly in that entity, because who's your counterparty? The network, right? We looked at some of the stuff with mining, right? So revenue under 606, you have to have a counterparty, you have a contract, which has rights that are enforceable, measurable, all these sort of things. So if you are engaged with a third party to do that staking on your behalf, which is common, hopefully that contract has some terms and conditions in there that we can look at to answer these questions. Now, of course, if you can't get there under 606, which is just a recent sort of accounting standard, there's either it's not revenue, it's other revenue. So there are ways to account for this, but those differences in classification can involve timing differences and recognition of that revenue. So anyway, there's a lot to think about in that space. But just as always, start those discussions early on with your auditor or with your tax professional or with your admin. I'm sure you have similar challenges.
Yeah, so as you can see, the space is changing. I would like to say daily, but it's probably more regularly than even daily.
Yeah, technology just accelerates faster than the pace of adoption.
Right, and we're talking about the technology is moving so much faster than the infrastructure behind it, and certainly the regulation behind it too. And with the pace that it's moving, I don't see it catching up. So it's important that we're communicating to make sure we do the best we can to stay on top of that.
I think having said that, the infrastructure has gotten
better,
way better, since our first CoinAlts.
Right.
And it's helping all of us to do our jobs a little bit better every day.
Yeah, and so as you can see, I mean, you have to live and breathe this space. So having great firms such as all the firms that are up here today, I think is really, really helpful, that have been in it and understand it and can help triangulate it to other situations, to accounting literature, to tax literature. That's a bit of an art right now than a science, but critically important. And to draw on past experiences is really helpful as we navigate those. Unfortunately, we weren't able to hit on everything that we face every day today. We only had 40 minutes. I think the panel was fantastic. We would welcome some questions. We have about a minute. If anyone has a question they want to have answered. It's hard to see up here.
There's one.
Yes. Oh, we don't take questions from him.
I don't want to beat a dead horse on the staking, but it's just two things about staking. So is it 100% certain that staking generates ECI, effectively connected income? And second, if you do set up a separate vehicle for staking, can you put people's minds at rest that that vehicle is not going to be separate to local taxes?
Yes and no. Okay, so when we talk about ECI, so with proof of work through that notice, it specifically says, rises to level of trade or business. So generally speaking, when you're mining, we're looking at that as trade or business income. So it's really based on how you want to apply that guidance to staking. Do you want to say, okay, well, mining is generally always going to be trade or business income. Do we think staking should always be trade or business income? I think, again, it depends on the level of activity. If you're running a master node, if you're staking and validating transactions at the same time, then yes, you're probably in a trade or business which would generate ECI. And again, ECI is only U.S. source. So if you outsource this, out of the country, and as long as all of the people who are actually doing the transactions are outside the country, or monitoring the wallet, I should say, are outside the country, you can get out of ECI in that way. But if you're just holding a wallet, like David was saying, if it's just sitting in the wallet, you're not really doing anything. We're looking at that more as passive income, so it shouldn't always rise to the level of ECI, but it can. And again, depending on the level of staking, generally with our funds, they have so many coins, they're probably rising to that level of trade or business rather than passive. And if you do put in that secondary entity, again, if it's rising to the level of trade or business and you're within the US, then you're definitely going to have state and local problems, or state and local taxes.
So we are around, certainly for networking hour and around the event. So any of us would be glad to answer any additional questions we have. We have run out of time. Wanted to thank the panel. You guys were fantastic. And thank you all.